Hey investors, it's Nick Stromwall with Oak and Vine Capital. Very pleased to announce the launch of our Oak and Vine Private Credit Fund. This is just going to be an amazing asset for three different reasons. One, it's going to be a portfolio of assets delivering very good current yield. It's going to be focusing on monthly preferred distributions along with quarterly profit sharing, creating awesome passive cash flow. We're going to have a preferred position in the capital stack. And this is an open-ended fund, meaning that you're going to get quarterly statements and you'll have optional liquidity after a 2-year period. So if you want to put in your initial investment principal, 100,000, and then 2 years later want to pull it out, you can do that. We're expecting low double-digit returns, and so it's going to be preferred paid out monthly along with quarterly distributions. And again, we're going to be partnering with Aspen Funds. This is the second partnership opportunity I've had with them. I've partnered with a lot of great operators, and what I really like about Aspen is they just have an amazing sponsor team, and they have a great portfolio of different assets. So we're coming in as a fund to fund, and you're going to be getting some great discounts on the opportunity to partner with Oak and Vine again. So reach out to me, Nick, at 612-451-6200, and follow along as I have an interview here with Ben, the Chief Investment Officer of Aspen Funds.
Awesome. Thanks, Nick, for that great introduction. And Oak and Vine investors, thrilled that you're on this webinar and interested in learning more about this private credit space. We're excited to partner with Nick and his team again and share with you this opportunity. So let's dive right in. This is our Aspen Private Credit Fund. We're calling this an opportunistic income-focused fund. Like I said, this is one of what we believe to be some of the best opportunities in 2024 and beyond from a risk-adjusted return standpoint. And so a lot of people, when they're looking at investment opportunity, they're looking just purely at what are the return numbers that I'm gonna achieve, but not adjusting that for the risk that they're taking, right? And so this is going to be focused on current income, but also capital preservation, lower risk in the capital stack, and also getting to participate in upside through profit sharing. So with that, let's dive right in. Obviously, got to give the disclaimer first and foremost. This is not an offer or sale of securities. You need to review our full private placement memorandum for all the risk factors associated with an investment offering like this. We'll be making forward-looking statements, looking at making projections. There's no guarantee of that performance, and past performance is not necessarily indicative of future performance. And again, please review the full PPM in the data room if you have interest in this fund. Okay, for those that may be newer to Aspen or less familiar with some of our management team, I'm just going to run through some of our management team and the bios. Bob and Jim, they're our two co-founders and actually started Aspen Funds over 11 years ago in the distressed debt space. And so this was really the advent of Aspen started through the last credit cycle and more focused on residential. But we've been doing a lot of what we're going to show you here in the more commercial sector in this kind of gap funding private credit space. And it's really coming full circle with the experience that we've built out in-house as with our team, vertical integration, and also the expertise that we have managing funds, managing credit based opportunities and investments. So Bob's background is really a technology background that transitioned into finance. He won the Ernst & Young Entrepreneur of the Year Award back in 2000 and has really helped us scale our business, help us build our employees to about 25 right now, and continue to set the vision, of course, for Aspen. Jim, he's really our resident real estate expert. So he's been in real estate for over 30 years on all sides of it, both on the asset side as well as the debt side. So it brings a real wealth of knowledge into everything that we're doing here, especially in this fund. Dan Schulte, he's our chief operating officer. He's been with us about 6 years. He's got over 20 years experience in asset management, private equity, real estate development. He was formerly the general counsel for Waddell and Reed, which is a publicly traded mutual fund company. Left that about 10 years ago and moved into private equity and real estate development. And so he brings us a real wealth of knowledge, both from a legal compliance side of things, but also from capital formation and evaluating opportunities, and also runs a lot of our development efforts. And then myself, my chief investment officer at Aspen Funds, are responsible for a lot of capital markets, so putting together all the funding sources for all of our deals, our funds, helping do and run all the acquisitions, asset management for all of our investments. And my background, if you don't know, is as a commercial banker, was formerly a lender underwriter before kind of moving into the equity side at Aspen Funds. I'm also the co-host of the Invest Like a Billionaire podcast. And if you haven't checked that out, definitely would encourage you to. Again, if you're new to Aspen, this may look, not familiar, but if you already probably seen this chart a few times. So this is our process for identifying deals. And I think it's important to just set the stage for how we look at opportunities, because it is very different than a lot of sponsors, operators where, they're a hammer, they're really good at one thing. And so everything they do is a nail, right? And so their hammer is really good at finding those nails. But as the economic cycles shift, as the opportunities shift, and the risk adjusted returns kind of create imbalance, it's important to be able to shift the investing approach based on the current economic trends and what's happening in the market. And so that's really how we've formulated the kind of first step in identifying where are the best opportunities, is looking first at those macroeconomic trends that are in play, likely to continue for a period of time. And then from there, we identify the best asset classes, best strategies to benefit those trends. And then we assemble best class teams, investor friendly structures, and put together an offering such as this. And then ultimately, as our management team invests as LPs alongside of all of our investors in every deal that we do. This is a primary way that we allocate our own capital, is through all of our own deals. So we have, ultimate alignment of interests and the ability to come alongside of our investors in these deals. A little bit of our track record. I've been on the Inc. 5000 for several years, been operating over 11 years in multiple asset classes, have over $200 million in investor capital we manage, over $500 million in assets, and have sent over $50 million in distributions since inception back to investors. We have a very broad set of experience in a lot of different asset classes. So mortgage notes and debt, credit. That's really where we started over 11 years ago. A lot of multifamily storage, industrial retail, as well as oil and gas. So we have a very broad set of experiences based on our management team's background. So mine is a banker, lender, Bob's in venture and hedge funds, Dan in development, real estate, Jim in real estate, in multiple asset classes. Again, if you haven't seen the podcast, I encourage you to check it out. This is our primary platform we use to help educate investors how to become better investors. So invest like a billionaire. And we're actually working on some cool things with this brand, Invest Like a Billionaire, that we've got is coming down the pike this year. So definitely encourage you to plug into that if you're not already. Get in the mix. We're putting these out at least weekly, sometimes multiple times a week, and really enjoy that. Okay, well, let's dive right in the real meat of the presentation on what are we talking about with this credit fund, private credit fund. So it's again called the Aspen Private Credit Fund, and this is an open-ended fund. We're focusing on providing credit to commercial real estate properties. And we believe there is a dislocation of the capital markets that's created a unique opportunity for non-bank lenders to come provide capital through a variety of sources, either preferred equity, mezzanine debt, bridge loans. And this is a structural dislocation. We believe this is a long-term issue that the traditional lenders are not meeting. And we'll get into this in the presentation. But it's also being exacerbated by the current dynamics going on in the economy right now. And so our fund, again, this is open-ended fund. We've experienced for over 10 years running open-ended funds in debt and credit products. And we're going to be focusing on providing current cash yield with upside through profit share, while investing in preferred positions in the underlying investment. So we're going to be in a capital protective position, which I'll explain what that is later, generating current cash yield plus upside in a really good position in the capital stacks. We're lowering our risk. So again, thinking about that risk adjusted return, this is the kind of, the best of all worlds, where you get some nice current cash, you get upside, and you're protected from your downside risk before common equity investors. Okay, I'm going to give you the next couple slides here. If you don't listen to the rest of the presentation, this will give you the real high level, 101 of the fund, why you should invest and how it's structured. So some of the reasons to invest, again, high current yield. So the focus of our fund will be on delivering high current yield cash flow paid monthly to investors with additional profits shared quarterly, which is passive to you. Again, there's not a lot of investments right now that you can go and earn, double digit yields in a preferred way in the capital stack. If you're going investing as an equity investor into a property, generally, given where the current cap rates are and current interest rates are, it's very difficult to find current cash flow. So this is solving that need, but you also get the upside through participation in the back end profits that we negotiate in these deals. Again, we're coming in a preferred position in the capital stack. So why does that matter? Well, you have to adjust all the returns and all the investments you make by the risk you're taking. And when you are lower in the capital stack, which means you have priority of payment before the common equity investors receive a dime, you're reducing your risk of capital loss and preserving that capital while earning a nice return on top of that. And so most of these deals, actually all these deals, we will have priority before common equity investors get paid. And in most deals, we'll have takeover rights or drag to market rights for events of default, which I'll explain what those are later. Open-ended structure. So investors love open-ended funds, and we've been running open-ended funds for over 10 years. And we really feel this is a great structure for this type of a investment product because we believe there's going to be consistent deal flow for a very long period of time. And really the position we're finding in the market, it lends itself to being open-ended. So I'm going to talk about this a little bit later. But what that looks like is we're going to have a 2-year lockup period, which you make the investment and then for 2 years you're locked in. But after that, there will be a quarterly liquidity with 90 days notice before the quarter end, similar to our other income fund that we have after the lockup period. So it is going to be best efforts liquidity, but the way we're designing the portfolio, we believe will generate a substantial amount of liquidity in a quarterly basis. More reasons to consider this. We have a strong sponsor team. We're the lead sponsor on this fund. We have an 11-year track record operating open-ended credit funds. We're leveraging our deep experience in this space, our internal staff, and networks that we've created for this. Alignment and co-investment. All of our management team is investing directly into this fund with our personal capital alongside of our LPs. And then our incentive structure as GPs is prioritizes a preferred return to our investors. And we also have a high watermark, which I'll talk about in a minute, which makes sure our investors are getting their returns that they want to get. And then lastly, a diversified portfolio. So one of the cool things about a fund structure is you get diversification into a lot of different assets. Our target check size is going to be $1 to $5 million. And as this fund continues to grow, we expect there to be dozens and dozens of investments in this portfolio, both across multiple asset classes, multiple markets, multiple operators, and multiple different time horizons to create a really nice, diverse portfolio to continue to protect capital. If you invest in just one deal, that deal doesn't perform well, you have more risk, right? So diversification also increases or reduces your chance of capital loss and increases that diversification. Okay, fund overview. This is a beefy slide, and this will be in the data room for you to download and look at. But I just want to run through just the structure of the fund, and then we're going to get into the strategy, our track record, and some of the actual investments that we've already got teed up for the first investments in the fund. We're going to be making regular distributions. We're going to be paying our preferred returns monthly as cash is available after a 3-month delay. Profit share will be paid quarterly as available as after 3 months. We're also going to allow compounding. So a lot of investors don't necessarily need the cash flow, but they like the thesis and the preferred position with that yield. And so we're going to allow quarterly compounding. You can turn that on, turn that off whenever you like, and you can start receiving the distributions. But if you want to compound and grow your capital account faster, you can compound quarterly. Again, open-ended fund with quarterly net asset value calculations. We're going to be funding the capital based on tranches as we have available deal flow. We're going to be investing, like I said, in preferred equity, mezzanine loans, and commercial real estate. Our focus is on generating current cash with some upside in the back end and in a preferred position in the capital stack. So that's kind of the tagline of the fund there, if you want to call it that. Investor protection. This is going to be non-dilutive, which means new cash is deployed into producing assets. We're not diluting investors. That's where we have the NAV calculation. High watermark. So our fund is going to have a high watermark, meaning that if net asset value per share decreases, we will not be able to take our carried interest as managers. So until those investors are made whole, and it exceeds kind of the prior 12-month high performance mark. Um, Returns reporting, like I said, monthly distributions, preferred return plus quarterly profit sharing, account statements of your NAV, and fund reporting would be produced quarterly. Liquidity, so we will have that liquidity provision, like I said, 2-year lockup, and then 90 days notice prior to the quarter end. If it's a large position in the fund, it may take longer than 90 days, so it is best efforts. But again, I'm going to share later on, how we're going to generate liquidity. But just want to, if you have a large position, it might take a little bit longer. So just be aware of that. But in most cases, for the smaller positions, 90 days notice is what we'll need. Um, Structure, $100,000 minimum investment. AUM fee will vary by share class. We are going to be getting an annual CPA audit. So this is something that we've done in several of our funds. Usually we do it once it hit a certain size, but we're going to come right out the gate with an annual CPA audit just to build that investor confidence and just right out the get go have a really, we believe, an institutional quality product for investors to invest in. We expect very low leverage in the fund, if any, and also welcome IRA investment. So this will be a great fund for IRA investors because of the kind of current cash yield, and we are can take that capital through IRAs in this fund. Okay, here's some share class overview. So we have 3 share classes in this fund, driven by a minimum investment amount. So our Class A shares are $100,000 minimum. Class B shares are a $1 million minimum. Class C shares are a $5 million minimum. So you can see here the preferred return on the Class A shares is 6%. The profit split is 70-30, 70% to the LPs, 30% to the GPs. So we're targeting a total net annualized return in the 10 to 12% range. And then the net cash yield, if you're receiving distributions, is what you can expect your actual cash distributions to be on an annual basis, somewhere in that range. So you have your total return, which includes your distributions plus your net asset value increases based on that back end profit. And then the cash distributions will be what's actually received. If you decide to compound your returns and you compound quarterly, the yields we expect in that kind of 11 to 14% range. And obviously, you can turn that on or turn that off whenever you like. And so we have better splits, lower fees on the higher share classes. You can invest in those if you can hit those minimums. We also anticipate bringing in other fund managers, different institutional investors that are already kind of teed up, ready to invest in this fund. We have a lot of deals in the pipeline that are we have really good deals. I'm going to share some of those with you in a minute. And we want to bring as much capital as we can right out the gate because we have a lot of momentum on the deal side of this. And then we're also expecting, we have a lot of interest teed up from institutional investors. And so what we're doing is actually launching this fund in multiple phases. And so we're launching first to our investor base, our current retail investors. And depending on how much we receive in commitments, we may actually go onto a wait list before we go into that next round of capital. But we've already got a lot of institutional interest from other fund managers that are going to raise for the fund. We already have a broker dealer that is looking to raise capital through registered investment advisors for this fund. And we also have large family offices, institutional investors that are looking at this as well. So we're kind of holding all of them off at bay to let as many of our investors that want to jump in as they can. And then we'll kind of go to that second round of the fundraising. Because it's open ended fund, you can always add to your position later on, but it will be based on as capital is available based on the deal flow coming in that quarter. So definitely, if you're interested, you can make those commitments. Okay, we're going to dive into some of the macro trends and then the fund strategy, our track record, and some of the investments. I'm going to kind of fly through the macro trends here pretty quick because we covered a lot of this in the masterclass and spent a lot more time, over an hour, talking about what's going on in the capital markets and the economy that's really creating this opportunity that we're seeing right now. And I'm just going to kind of fly through these. You can go watch the masterclass if you haven't, or watch it again if you want a refresher. But ultimately, what we're seeing is that tighter credit markets are creating a pretty big gap in the capital market space. And this is being exacerbated right now through a lot of the distress and just challenges that certain commercial real estate asset classes are seeing and current lending environments are seeing with the higher interest rates. But it's also been going on for many years before this, and we expect it to go on for many years after this, right? So we're kind of in this really unique spot right now that we actually think is creating a really good time to jump in. But we've already been doing these types of deals for several years, which I'll share some of those in a little bit. But what's happened is, um, at a whole, traditional lenders they're pulling back on leverage ratios, and part of that is due to kind of negative cautious sentiment that's happening right now with property values, with interest rates. We have a lot of maturing loans across the board here over the next several years. So that is reducing the bank's appetites for new money, also reducing their payoffs. And so a lack of payoffs from banks restricts their availability of lending new capital, right? So the way that banks work is they can lend a percentage of their tier one capital to borrowers, and if they don't churn their portfolios, if their balance sheets don't rotate and they have payoffs from other deals, they don't have new capital available to kind of make for new deals. And so that's continuing to restrict capital for new deals. We've seen a little bit of a bubble in the bridge loan sector over the past 2 years. There's really an acceleration of capital that was put out in the bridge loan, which is creating a lot of stress in the system. And really what's happening at a more structural level, right? Aside from some of these shorter term things that are happening, we're seeing continued increased regulations on banks. The Basel III Accord is set to increase the stress on the financial system, right? It's going to increase capital requirements. It's going to increase liquidity requirements, increase compliance. And it's really going to have a inordinate impact on smaller lenders, smaller banks. And that's, generally the larger banks, the large institutional investors, they're going to continue to have access to capital markets, but the smaller operators, the smaller sponsors that need capital, they're going to continue to have a harder time getting the smaller checks, and that's where we're going to be focusing on because we think that's the biggest opportunity um, over the next several years. Obviously, a lot of foreclosures, and investors are reticent to invest in the same deals of yesteryear, right? But we still believe there's a lot of long-term fundamental strength, especially in multifamily, where a lot of the stress is acute because of the housing shortage that continues, strong household formation, and really the historically high correlation to inflation that housing has over the past many years. We're seeing a chronic underinvestment in housing. Um, the single family buyer pool is shrinking. Renting continues to be substantially cheaper than owning, especially with the higher interest rates. Household formation is strong, which drives demand for rentals. At the same time, a lot of these properties are experiencing stress because their debt costs are up massively. Their operating costs are up a lot. Vacancies are up. Rents going down. And so all of this is creating this stress in the system, right? That is needing to have something to solve it. We're also seeing a lot of deliveries over the next several years. That's going to slow down absorption. But as we've said many times, if you've been following us, the real estate market is not just one market. The real estate market is a composite of many markets across the U.S. And so we're actually seeing a difference in the top quartile markets, the top performing markets versus the bottom performing markets. And the biggest difference is supply, right? Which makes sense. The high supply markets are going to be struggling a lot more over the next several years. And so this creates opportunities, right? In the top quartile markets, there's actually expected to be 6% rent growth this year. It's in the Midwest, the Rust Belt, the Northeast. The high supply markets, they're actually having rent decreases. And, some of those high supply markets in Florida, in Austin, Boise, Atlanta, a lot of these names. And it's really short term in nature because these are high population growth markets. So eventually the absorption will continue. But there's going to be opportunity kind of within different markets that we'll be able to find. So what's the benefit of investing in private credit, right? You've heard this term a lot, and maybe you still are a little fuzzy on what that actually means, what it looks like. But really what it is, it's a kind of a broad word to describe credit lending, credit like lending, and lower in the capital stack. So in the capital stack, you can see there on the picture, you have your senior debt, mezzanine debt, preferred equity, common equity. And those are basically structured in the order of priority in being paid, right? So the senior lender always gets paid first. But then after that, either the mezzanine debt lender or the preferred equity lender gets paid next before common equity. And so in a lot of cases, when you're coming in as preferred equity, mezzanine debt, you have a substantial amount of margin and cushion covering your position because before the common equity investors can get paid a dime, you have to get fully paid off all of your principal, all accrued interest, fees, et cetera. And these operators and sponsors, they want to protect their equity, right? Because this is how they do their business. They have to have equity to raise money for these deals, and so they're very very focused on protecting that equity, which means they're going to protect us, right? And because of where we're at in the capital stack, we act as a quasi lender in a lot of cases if we're preferred equity, but we are having a stated current cash flow, current portion of the interest that they have to pay us current. We're lowering the capital stack, which reduces that risk of loss. And then we also can negotiate certain rights. They're called either takeover rights, drag to market rights, changeover rights. These are basically if they're not meeting the expectations or the covenants that we've set in place, we have the ability to either take back the property and operate it ourselves, or force the operator to sell the property at that point. Why private credit? This is got on the uh, a lot of institutional interest. So this is basically a chart showing allocations going into next year of a lot of institutional investors that are planning to increase their allocation to private credit. This is from BlackRock of basically the risk adjusted returns over the next several years. They're expecting direct lending, direct capital injections into properties to have the highest level of return with the lowest variance of return or risk over the next 5 years. So it's gotten a lot of eyeballs on it. A lot of people see the opportunity here. It's just how do you play it? So how do we source deals, right? We've been in the space for a long time, and so we have a pretty substantial network. And it's going to probably come from three primary sources. One is going to be placement agents. So we work with capital brokers. So these are brokers that are not selling the property, but they're actually looking to help the operators place either debt or equity in the project, and a lot of times preferred equity. And so we can get direct deal flow from these brokers, and these are pre-vetted deals. The brokers are very selective on the deals they bring to market because they have to meet their standards. They have to meet basic underwriting, and it's also very difficult to place capital under $5 million. So I said before, our target is that $1 to $5 million sweet spot, and I'll explain why that's a sweet spot later. But it's there's not a lot of competition there, and we're also going to source directly from lenders. So we have a lot of lending relationships from all the deals we've done over the past decade, and a lot of these lenders, they're in deals that they actually want to stay in, but they've tapped out their ability to continue to extend capital. So if there's a borrower that needs a capital injection, a capital infusion to increase cash reserves, to finish a renovation plan, they may be tapped out. But they'll say, "Hey, can you guys come in and help the borrower here with a capital infusion? And we'll be finally either taking a second lien or structure preferred equity rights, so we can source directly from the lenders and their deals." And the others are direct from the sponsors, the operators. So we have a big network of sponsors and people that work with sponsors to generate deal flow. And we have a very compelling product because we have this fund that has committed capital, and it will be able to move quick and move in a range of investment that a lot of providers are not giving. So we can actually negotiate pretty compelling terms. So some of the types of deals that we are going to be um, looking at is kind of in two broad buckets. You have your existing deals and you have your new deals, right? And so existing deals, these are properties that are already owned by the sponsor or operator. And it's usually on some spectrum, right, of either distress situation or they need some kind of capital injection. I want to be really clear. This fund is not designed to be a rescue capital fund. We're not going and doing distressed investing. You can potentially earn higher returns, but you're also taking a lot more risk, especially in the current environment right now. And so this is not designed to go in, riskier deals with, high leverage situations and become a rescue capital source that with the hope that they can pay off. That's not what we're doing. So there's going to be very, very few deals that we would classify as distressed. Another thing I want to make a point of too, where I've seen a lot of funds pop up recently, is now a huge swath of preferred equity, private credit funds, and a lot of these funds are designed just to basically backfill capital into their own struggling deals. That's not what we're designing this fund for. We actually see a real opportunity in the market and going and taking advantage of that, not just trying to have a roundabout way to fund our own deals. Capital injection. Um, this is an example of some deals like this where it's not distressed. They actually got really good in place senior debt. So they actually got, say, fixed rate debt um, with a low interest rate, and they need to finish the renovation program. They need to bolster reserves, the cash reserves, but they don't want to go out to the market and refinance because it's a lot more expensive. So we can come in that scenario with that capital infusion, help finish out the business plan, usually stay in a really comfortable leverage position, and then get taken out once that property stabilizes to that new NOI that they're looking to hit, and then we get paid off either through a sale or through a refinance of that property. The other kind of category of deals we'll be looking at are new deals, and this will probably be the larger portion of what we do. And the overall goal is just to increase leverage, right? Because in the smaller part of the market, there's just not as much capital availability. And so there's kind of a few different categories we'll fall into. One would be kind of a quick close and gap funding. So this is, in some situations, the senior lender falls out last minute. We've seen this before close, and so we can come in and help close a property, and then do a short term loan to get paid off once they get the permanent financing in place. And I have an example here. I'm going to show you of just that. Another example of gap funding is they can't raise all the equity, so they have the senior debt in place. And another example I'll show you in a minute, the borrower couldn't raise all the equity in time. And so they needed to close the property, and they backfilled the equity after close and paid us off through that. So there's a lot of opportunities, these kind of shorter term bridge opportunities they're always available, and they create really great velocity of our capital, and we can get pretty nice returns on those. Another really great vertical that we've seen a lot of opportunity in is loan assumptions. So these are generally going to be more stabilized properties, but they have some kind of value add component. They are assuming a low interest rate, senior mortgage, usually from an agency lender, say Fannie or Freddie. And so we had one right now. I'm going to show you in a minute. They have 2.9% interest rate. The goal is to increase the overall leverage, though, because that deal, the senior lender only goes up about 45% leverage. So we can come in with a little bit more leverage, a little more expensive capital, but it still makes the returns better for their common equity investors. And we can come alongside, help them achieve the business plan, increase the leverage, and a really comfortable, low position in the capital stack. Another area is new construction. And so we believe construction is actually a great place to play right now because we've seen a huge amount of supply being delivered to the market, but we're seeing construction starts just fall off a cliff, right? As a lot of capital is pulled back, a lot of people are nervous to continue to create new product. But when these products start to hit the market, when these properties are completed construction wise and will be starting to lease up, there will be that supply will be absorbed, be a lot less availability, and there's a much lower capital availability on construction generally, but also especially right now. So again, the goal is to increase the overall leverage. Here's kind of example of a portfolio mix we're targeting. Now, this is not guaranteed. This is kind of what we're shooting for at any point in time, given payoffs and other things. It's going to change, right? But ideally, what we want to see is a balanced mix of preferred equity, mezzanine loans, bridge loans. So a large chunk of it is going to be preferred equity. And I'll show you some examples here. And then mezzanine loans, second position loans, these are generally going to be where we can come in with a secure position behind a senior lender to complete a business plan, the capital infusion. And then the other 25% we want to keep as bridge loans. So we're going to keep a nice chunk of our portfolio designed to have that just velocity of our capital. So we can have liquidity, have payoffs coming in all the time. And we can also basically compound our own returns at the fund level by using that capital in multiple deals in the given year and generate nice yields for investors. Our focus is going to be on multifamily properties, but we will invest in other commercial real estate asset classes. Our check size is going to be that $1 to $5 million per project. Again, a large gap in the market for those types of deals. Lot less competition, so we actually earn higher returns because there's less availability, and it actually increases our fund level diversification, right? So if we can make smaller investments into multiple projects, that increases diversification into more deals. gives us geographic diversification. We're focused on stable or growing markets. Some of our unique advantages. Again, we've been doing this for over a decade, so we're very sophisticated underwriting analytics back end. We've been servicing, underwriting, managing credit portfolios for over a decade. We've built out proprietary dashboards to monitor portfolio performance. Going to continue to do that here. One of the unique advantages is just a market advantage we're going to have because of that, limited availability in that $1 to $5 million check space. We just have less competition, and the real reason there's less competition there is pretty simple. One, the larger preferred equity, mezz debt providers, they're usually institutional, and they're coming in with, say, they want to deploy $20 million. Sometimes they'll go down to $10 million, but they don't really go below that because they have a lot of capital to deploy, and they want to do as few projects as possible so they can just deploy a lot of capital really fast. So that's one issue. Then the other issue is kind of the more middle market providers of preferred equity. Most of them are actually raising the capital on a deal by deal basis, right? So they go have a deal that they like, they go raise the capital, put together their own syndication, and fund it. The issue with that is it's about the same amount of work to do a $2 million deal as a, you know, $12 million deal, and to make a lot more money on a $12 million deal. So they will generally do those versus the smaller ones. For us, because we have a pooled fund and we can continue to raise capital and bring it in as we have new deals, we can move quickly and we can do these smaller deals. And it's actually a competitive advantage for us in what we believe is to improve the fund performance and diversification. And then last unique advantage we have, which is a pretty big advantage, a lot of providers of preferred equity in the space, they don't have experience operating deals, right? And the advantage that we have is we have been operating a myriad of deals in multiple verticals across a very diverse spectrum of where they're at in the process. We've done construction, we've done redevelopment, we've done heavy value add, we've also done stabilized deals. So we can take over a deal if need be. It's not the kind of core way that we're going into a deal expecting to take it over, but we're negotiating those rights in the front end to where if we have to, we can. And we're also staffed to do that. A little bit of our track record in credit. We've been operating credit funds for over the past 10 years. We have 4 operating funds. 2 of them are open ended. We have 2 deals that have gone full cycle. We've bought over 4,500 assets since inception. A lot of those are residential, but there's a big chunk of commercial ones as well. We deployed over $100 million of capital into credit-based products with $300 million of unpaid principal balance in all 50 states. Investor distributions over 45 million. We vertically integrate our servicing asset management. And you can see our full track record in our data room. We have the performance and details of all these funds in there. Our track record in real estate. We have over $300 million of assets that we manage, and it's across multifamily, industrial, retail, self-storage. We're 2,000 units across 10 assets, and again, a variety of strategies, all the way from construction to stabilization and experience managing through all those stages. So here's a case study of a deal we've actually done a while ago. This is a gap funding deal. So this is what I mentioned. The sponsor couldn't raise all the equity in time. They had to close. They had, I think, an IRA investor that just couldn't get the custodian to send the funds, but they had to close quickly. So we're able to gap fund that purchase and help them close the project. And then they backfilled the equity raise when that investor kind of came in, and the loan was paid off in 90 days. So it was a $500,000 loan. So we will sometimes go below $1 million, but our target is $1 million. This was a second position lien. We actually got secured on this behind the senior lender as a 94 unit multifamily property, actually here in our backyard, combined LTV of 75%. So I had a 25% equity cushion, and ultimately earned about 15% interest rate on that with our origination fee and interest. And they got paid off within 90 days. And then we can again recycle that cash into new opportunities and generate more velocity on that capital. Here's another deal that we did, a capital injection. This was a value add first position loan on a multi-tenant strip center. So this was a borrower that had purchased this building, a strip center, at a really, really good basis, and needed additional capital to kind of complete the renovation program. And it's because it was a small amount. We just took out the first position loan and lent him the capital. So it was a $1.5 million loan. We had a first position lien, but we had an as is appraisal pre renovation for $4 million. So very, very low leverage, 37% LTV. This borrower was able to improve the curb appeal, restructure leases, gain more attractive quality tenants, and then now that he's stabilized the project, he can go and get more long-term stable financing. Because there's kind of a gap, right? If you're doing a value add, it's difficult to get the more attractive financing structures until you kind of hit a certain point of stabilization. And so that's what he's able to do. We're actually set to get this loan paid off actually in a few weeks. Okay. So those are deals we've done before. I'm gonna actually show you a couple deals we have that are going to be going into the fund here pretty shortly. We're excited about some of these. So one of them is a loan assumption. So I mentioned this one. This is a multifamily property. Actually, it's right in my backyard. I actually live in Lee Summit. Um, the sponsor is assuming an agency loan of 2.94% interest rate, so an incredibly low interest rate. They have 3 years left on that term. The senior loan to value is 45%. So there's still a lot of equity they need to raise. So we kind of come in with $1 million investment that brings up the leverage to about 55%. So we still have a 45% equity cushion protecting our position. And this is a cash flowing project. So this is a light value add program. They're already achieving the rents they need to hit on some of their units, and they can just kind of finish that out across the property. And the way we structured this is we get paid 8% current pay. So we're getting that cash flow piece. And then we're getting 6% accrued back end. Plus, we get some origination points up front. It's a 3-year term. It's coterminous with the senior mortgage. So we'll be taking out at refinance. So once they achieve the business plan, and we'll get taken out the refinance when they have to go out to market to refinance the senior loan because of the maturity. They're a vertically integrated sponsor team, so they have property management, construction in house. They have a lot of this exact same business plan in this market. So, experienced sponsor here. The NOI that is currently being generated already supports the debt service of both the senior mortgage and our current pay. It's a very conservative business plan. And ultimately, we have rights to either drag to market if they stop paying us, or once our term hits, they have to take us out. So whether they want to keep the property, they have to refinance us out with new debt, or they have to take us out with new equity. And if they don't, then we can take over the project. Here's another acquisition we're looking at. Really, really cool opportunity. This is outside of Atlanta, Georgia. It's a Class A industrial building, just a few years old. It was a build to suit tenant that's now moving. So their basis on this, they acquiring this property, a Class A industrial at $52 a square foot. It's a 200,000 square foot building, which is very hot right now. The kind of sub $500,000 square foot buildings are going like hotcakes, especially in this area with it's really close to a lot of distribution um, points. So we're layering in preferred equity, which helps them increase their IRR. It's a $2.1 million loan. It's structured as preferred equity. We have takeover and forced sale rights. Our combined LTV is 75%. We have 8% current, 8% back end, 2% origination, 2% exit fee. We have a 2-year term. So the goal here, they're acquiring this at about 30% below replacement cost. So an incredible basis on the property. We're going to get a new tenant in place and likely sell at that point. They might refinance this out. So it's my guess is we get taken out before the 2 years because they already have a lot of interest in the building. This is an institutional level sponsorship group. They are very, very deep experience in industrial. They've been doing this a long time. I've been trying to do a deal with these guys for a while. Very, very experienced, strong balance sheets. And the property is a really, really good geographic location in the Southeast, kind of a key point across multiple distribution centers. Again, conservative business plan, great basis, lease it up, ideally to a single tenant, but can go to multiple if they need. Short-term business plan, pay us off within 2 years. Okay, that's pretty much it. I'm going to run through the kind of last slides here, but I want to talk a little bit about just our support team. So obviously we have very deep experience in house. We'll continue to do asset management and servicing of these investments and loans in house. We are going to be utilizing CBIZ, who's been doing our audit for our other debt fund for several years. and they're going to be taking over that audit for this fund. They're a top 10 auditing firm in the country. They're also going to do the tax preparation. We've worked with Polsinelli for all of our offering documents. We get their advice in tax issues, John Business Council, some more business structure, strategy, and compliance. We've also been working with McDowell Rice Smith Buchanan, which is a law firm actually here in Kansas City, where they specialize in working with lenders and preferred equity providers. They negotiate with the sponsors and the lenders. They assist in deal due diligence, legal doc review, et cetera, et cetera. So we've got a really great support team that we can utilize in different areas aside from our internal resources that we have. So with that, that's all I have for the presentation today. And depending on the demand, we may go onto a wait list pretty quickly, even before we kind of go to the next phase of capital raising, which is going to be the fund managers and institutional capital. So definitely get your commitments in if you have any interest. Our team will follow up with you. We're going to put a link to the data room here on the next slide, so you can take a little picture of the QR code. We'll also send it in a follow-up email and with the recording, so you can click on that. This presentation will be recorded, and you can review the deck. PPM will be uploaded there as well. So any questions, please reach out to our team, and they'll answer any questions, schedule calls, and get your commitments in. So I have a place where you can put your soft commitment in. Again, it's a soft commitment, so you don't have to be 100% sure, because I know everyone wants to review legal documents before they sign the documents. But please don't put a soft commitment in if you're not expecting at least a high possibility of making an investment, because we do go first come first serve. So we'll kind of go based on those commitments coming in. But if you're not responsive or not wanting to move forward, we'll kind of move up to the next spot in line and offer that spot to those that are ready to move forward. So with that, thank you so much. And I really appreciate y'all here. Here's the link to the data room. You can click on that, or sorry, do a QR code with your camera. We'll also put the link here in the chat, and appreciate y'all sticking around. I actually do have a few minutes here. I have a hard stop at the top of the hour, but I'm going to do Q&A. So you guys came live, and you get the benefit of asking questions. So I've been seeing some questions kind of flow in as I've been talking. So let me kind of catch up here. If you scroll up a little bit, make sure I can get them here. Let's kind of go through. So I hit the yield. Yep, there's a compounding option. So you hopefully saw that. So the minimum is 100,000. Time commitment, really have the 2-year lockup period. We even have the option if you have a circumstance you can't control, you can request an earlier redemption if needed. Again, that we don't want to design this fund as just a piggy bank where you're taking money in and out all the time. But because we have that liquidity being generated from the internal payoffs, we could potentially meet that. So reach out if you have an extenuating circumstance. It may not be able to meet it, but at least you could ask if it's before the 2 years. So we got tax treatment. Yes, this will be a K1, and yep, we'll have those 3 classes shares. Again, if you come in for the first 5, you get the class B for 1 year. You do have to hit a $100,000 minimum, so we're basically giving $1 million share class away for $100,000, which is a pretty sweet deal for the first 5 million. 1031, we can't accept 1031 capital in this fund, unfortunately. AUM of the fund, so obviously this is a new fund, so AUM right now is 0, but we expect this to grow over the next 2 years, probably over 9 figures. The goal is to get to multiple 9 figures, so several $100 million of AUM is the goal. Good question. Will the fund borrow? So I did hit on that a little bit. All the returns that I showed before are unlevered returns. So we do expect to use a little bit of leverage, either at the fund level through a line of credit to help fund acquisitions, and keep cash deployment very high, because it's going to obviously increase yields. We also will explore kind of asset level leverage. If we do, it's going to be very low leverage. So it's generally going to be less than 25%. But at the current yields we're earning in the, say, 16 to 18% range, sometimes as high as 20% gross yields. If you add a little bit of leverage on that, benefits everybody because we'll be able to cash flow that from a fund standpoint, and we'll generate a little bit of that extra margin to compensate for cash drag if we can't deploy all the cash in a given quarter. Um, and Yeah, so the cool thing is because we're structuring this as a profit share, all of our investors benefit from leverage versus if it's a flat amount that's being paid out as a preferred return, and that's it. You wouldn't get the benefit of leverage; you just take more risk. So with that, it does benefit the LPs as well. There is the potential for UBIT. It's again going to be very minimal leverage, if any. So UBIT's going to be a very minimal, and there's also some changes kind of coming down with the tax reporting, which again I'm not an expert on, but in talking with our accountants, some of the UBIT rules are changing to where it's really not that impactful for IRA investors. So there's uh, yeah, obviously consult your own tax uh, CPA, but it should not be very impactful from a UBIT standpoint. Will the fund be lending to other Aspen projects? Yeah, great question. There's a possibility of that. We have established an advisory committee that you'll see in the PPM, and they will advise on any kind of internal conflicts of interest. But we don't anticipate there being a lot of Aspen investments that we do, and we would obviously disclose those for any kind of internal deals that we did. And again, the goal for this, like I said very clearly, is not to go and raise capital just to fund all of our struggling deals, which I've seen other operators do. And we actually don't have really that many struggling deals, if any. So it's not really a need that we have. But there's a possibility that down the road this makes sense from a capital market standpoint. This makes sense to go refinance. So we can use this if we need. But again, that will all be very clearly disclosed, and we have an advisory committee to advise in those kind of conflicts of people that are outside of just Aspen. Um, so I got some real work examples there. Um, so all the returns that I shared are net of all expenses. So the expense ratio should be pretty minimal. The only real fees, some operational fees, but pretty much all of our legal fees are going to be pushed to the borrower. All of our diligence fees will be pushed to the borrowers. And then we have our AUM fee. We have a one-time origination fee once we close a deal, and then we have our carried interest if we're performing on the portfolio. Um, yep. So fees subtracted from returns. Absolutely. The returns I showed are all net. Um, what potential risks do you see in the fund? What measures are in place to mitigate them? So yeah, I covered a lot of that. Basically, the biggest risks are capital preservation, right? Because that's the number one risk if you lose capital. But being lower in the capital stack reduces that risk. Um, and then the other risk is not being paid current, right? So on all of our deals, we have a portion of the payment stream that they are owing us as current and back end, and it'll depend on the project how that gets split out. If they stop paying us current, that triggers these takeover rights or for sale rights. And so it's very clear in these deals that if they stop paying the current pay and they realize that we can take over the deal or we can force them to sell. So we have an ultimate protection to do that. Obviously, we don't want to do that because we'd rather just get paid current and get taken out in normal course of business. But that's how we protect and mitigate that risk of not getting paid current because we're obviously paying our investors, a current yield. And so again, we think it's great from a capital preservation standpoint because you're lower on the capital stack, and we have the rights to execute on those risks if we need to. Geographic focus of the fund, there's not a stated geographic focus other than we like Midwest markets. We're here in the Midwest. We've done a lot of investing in the Midwest markets. We will invest outside of that. We will look at the market by market. We want to see growing markets or very stable markets. A lot of it's driven by the expertise of the underlying operator sponsor and their kind of field of expertise. So we expect to go outside of that. I mentioned the industrial deal is outside of Atlanta, Georgia, but it's a really hot area for industrial. We have a key expertise, core competency in house for industrial. We do a lot of industrial developments, and as another kind of core competency. So that's an area and vertical we feel very comfortable taking over if need be. Um, Okay. Why do large investors receive better returns than mom and pop workers who only invest 100,000? Good question. It's kind of the standard expectation, right? If you're going to be investing a pretty big amount, from our standpoint, that single check is worth more because we can go and deploy it into more assets and scale the fund faster. So we're willing to take less fees. Additionally, the bigger fund investors, they generally expect to have better returns. But the thing is, it's not coming out of your returns, right? So the way this is structured is it's just coming out of our GP returns. It's not a fixed pool, and the $5 million investors take some from you. They take more from the GP. So it's come out of my pockets, not out of your pockets, for the $5 million investors. But from our standpoint, if we can get more capital, that gives us the ability to grow the fund faster, have more buying power in the market to do better deals, and it benefits everybody by doing that. The Basel III regulations, we don't anticipate those coming into non-bank lenders. And again, we have experience doing a lot of housing and mortgage lending from our other credit funds. Those have a lot more compliance issues with consumer compliance laws, right? These are business loans, and they are much less regulations outside of the banking world. We don't expect the Basel III rules to impact us at all. Um, so is this fund designed to run to perpetuity? Great question. As of now, yes. So the idea is we see a structural dislocation in capital markets, an opportunity for this to go on for a long period of time, just like we've run our other open-end funds. At a certain point, if we believe that the opportunity has been gone and there's no more, we can't achieve the same level of returns we want to hit, and the risks we're taking start to exceed the kind of underwriting standards that we're establishing, then we would decide to close the fund and wind it down based on whatever existing assets are remaining in the fund and just return all capital and profits back to investor as the sunsets. The nice thing is this way, because the assets aren't really going to be longer than 3-year terms. That's going to really be the kind of high end of the investment term. It would naturally wind down over about a 3-year period and pay back investors, the profits and capital over time. Um, so yeah, great question on the income. It's likely going to be mostly portfolio income. The back end uh, portion of the return uh, will possibly be capital gains. We're still getting some feedback from the tax accounts on how that's going to be, and this is going to be a K1. So any of those more favorably taxed gains would be passed on to the investors through the K1. So with that, great questions, everybody. Thank you so much for showing up. Really appreciate it. So, again, go to that data room if you're interested. Please put a commitment in. Our team will follow up with you, and we'll be sending out the recording here shortly if you weren't able to watch all of it. And appreciate you all for stopping by. Thanks so much.